Welcome back to another video, everyone. And today is a really special day because I'm going to be talking about my model really intricately. We're going to talk about every version of my model, every entry you can get from the 30-minute PO3 leading to the rest of the day, 4-hour continuation, reversal, 90-minute continuation, reversal, and just in between those things, what can happen. So, this first slide is just everything that we need to know that I'm going to be talking about. True opens on the right side, which put it to present. True opens, simple QT, cycle alignment, also QT, gap alignment, and PO3 alignment. Those are market maker or just ICT concepts, reading price action. And then we have more concepts that we use to analyze price action using standard deviations like quadrants and OTE. And then our Kraken correlations that we use for our point of reversals, including the regular trading hours and electronic trading hours, SMTs, mostly regular trading hours for new daily opening gaps and new weekly opening gaps. But we have a few SMTs that we can use in this. So we have if you want to see 30-minute PO3 entry criteria, and then our 4-hour. This is on the 4-hour PO3 video, which I think is like my most viewed video so far, which is pretty cool. But this is what we're going to talk about. First, ICT concepts to start it off. Then we're going to get into QT and then just continuation for the PO3 high time frame, safe continuation entries, and then just any continuation that is valid. So first, let's start with ICT concepts. And the first thing I have written down is gaps. Gaps and quadrants. Gaps are such an important concept. Gaps are this. New regular trading hours gaps are large gaps in the market that are just put in the market. You cannot take it out. It's literally programmed into how you can see the market, electronic and regular trading hours. And so this is an old screenshot from last year, and I've noticed this MMXM. This is a very, very clean one, and both using the first presented and the new weekly opening gap to reach the draw liquidity or to set up for it at least in the 30-minute PO3 to then continue in the 4-hour. And this is when price action was a bit slower in 2025, less momentum. But I want you to notice how even electronic trading hours, we don't even have to look at regular trading hours and where Asia, London, previous day low is. We can just look at electronic and we can get added data. Plus electronic, like when you add all these confluences, all this data together, then you really start to see the market in a different light. Look at this quadrant. You can enter off of any 5-minute gap above where we're moving to the next one lower. And then off this first presented, we tapped it and then literally just shot up to our draw liquidity in that 30-minute PO3 after filling the new daily opening gap. Like, look at that. That was just perfect. So, reading gaps. Whenever there's a gap, I'm always putting quadrants on it. I'm grading the quadrants of the candles, the candle bodies, the wicks, and the gaps. That's really how I analyze the candles, the wicks on the higher time frame. Because when I refer to the anatomy of a candle, that the most important thing when we're trading is figuring out when either our 4-hour candle is going to form, our body and our wick is in place, or our 30 or our 90-minute candle, is going to do that. And same with our 30-minute. So how I look at the anatomy of a candle, especially if we're trading 10 a.m., is after this 10 a.m. is put in place, any CISD after that, and the wick is confirmed for that high. Then we're trading into the direction of our 4-hour, and then you have to keep in mind that we are going to have a retrace, a pullback, to then close in that 4-hour. Same thing with this 90-minute. I know that this 90-minute is fractal inside this 4-hour, and this 90-minute is going to continue the move of the 4-hour, but we're going to have to put in a wick first. So that's another high time frame re-entry, our 30 or 90-minute PO3 and our 4-hour PO3 from something like a daily, if we just move up ahead a little bit, from like a daily move right here. This 30-minute PO3 continued for the 10 a.m. You see we had our retrace. This is our wick right here. And then we moved lower, 10:30 right here. We created our wick right here. This 10:30 open. We created our wick to tap into 10 a.m., which was premium of the range, which was 15-minute order block right here. All these things aligning that if we're going to go higher, then we're probably going to go to OTE and then drop down, or we're just going to drop from here, telling me that in distribution of the 90-minute cycle, right when 10:30 opens, we're dropping to our standard div projection. Like that's That's perfect right there. That's not even the only example we have. There's this one, there's this one. Like it's just there's so many examples. I'm just reusing these ones because I like the charting. So a sweep of 30-minute PO3, a great example would be this right here. 30-minute PO3 continuation right here. Usually this 10 a.m. continuation would sweep something here, but we just tapped into a gap. But have you noticed how on the continuation versus the reversal right here, we're moving to a target in 30-minute PO3, and then we're reversing from that target in the 4 hour. But in our 30-minute PO3 10 a.m. continuation, we are moving to the target, retracing to the OTE of this range to stop out people who have stopped break even or got in too late, and then continue on the higher time frame to the draw of liquidity, which ended up taking until like 11:20 to get. So from 9:30 to 11:20 was the move, but you were also really close to it at 10:20. At 10:30, not really 10:30, but like 10:10, you were really close to your draw liquidity, and it took another hour and a half for it to get there. So for executions like this, sometimes I don't even want to hold it for that long extra time, and I'm expecting a retrace. So I will exit at this, like one to two, barely two and a half, something like that. So that is really, really important. The anatomy of a candle, we were looking for that CISD to confirm the wick, so we don't have to put on, like, we don't have to do anything after the trade. We just have to watch it. We don't have to move the stop. We can put stops break even because we know that the body is confirmed. Usually I like to put stops at the body before I know that the wick is confirmed, like a little bit at the body, just because if I'm wrong, then I'm gonna get stopped out and I can re-enter. But keeping it at the body, your stop should always be safe unless the wick isn't confirmed. And then holding based on time, we're just holding, like I said, our bottom is going to be created, and usually we're going to retrace, make a smaller wick on the bottom when we're in the direction of the 4 hour, but still holding based on time. If we're going in the movement of the drawn liquidity and we take the drawn liquidity and it's only like 2 hours in the 4 hour, then hold it longer. You have an entire 90 minutes to hold until 12, and then you have one after that if cycles are aligned to hold to 2 p.m. So holding based on time really gets you past where the drawn liquidity is and gets you into how are the candles volatility and volume gonna play out in this candle closing. And you're trading based on the candle movement and getting the most points out of your trade rather than drawn liquidity. I mean, of course, you can partial there. You can take off most of your position at your targets, and you can take off all of it at your targets. But I'm just saying, learn to hold. Because no matter what you're trading, holding is always going to increase your RR, no matter what. So, all gaps, to review this, all gaps in the week can be used for reading the direction. I mean, people talk about candle range theory, using the next day candles. ICT says use the previous 3 days. Specifically, I like to use 3 days because usually the overlapping isn't too aggressive and you can use the past 3 days candle. Even like true day opens from previous days that had devil's marks, you can use those as targets as well. But usually I don't go more than the week. Usually in the week, I use the gaps for the week, and then it gets narrowed down to the previous 3 days when it gets later into the week. But for gaps, that's really as far as you need to go. And then the anatomy of a candle, it's just so important. We're trading based on this. We're trading based on the anatomy of the 4 hour PO3, the 30-minute, and the 90-minute. So it's just important to know how it's going to play out on the lower time frame. And to understand that, you just have to know how the high time frame candle has to move. And we talked about this in how 90-minute candle moves, how 90-minute market maker or 90-minute market makers, 90-minute market maker models. Sorry, that's a terrible sentence to say. But yes, so 90-minute charts, we talked about the fractal correlations between the 5 minute and the 1 minute, and so that is such an important thing. The anatomy of a candle literally is what makes or breaks your trade if it's a high time frame safe trade or not. In this are the market maker concepts, just to write them down: time frame alignment, premium and discount OTE, gap alignment, and then session and true open liquidity. So liquidity, basically, we have gap alignment, and then we have our premium and discount OTE, which is our ranges, and then time frame alignment, which is just using all candle time frames in a fractal way that they all align so that we can use them in descending order to analyze the charts for an entry. I'm not going to go over this. I kind of butchered this from Snelsky, but this is what time frame alignment is. So these are what you should be using based on QT and then MMXM related to QT. And then this is how I use it. So my time frame alignment is a bit different. I go from if we're looking at how the banks are trading, then highest time frame to low is 3 month correlated to 1 month, and then the 1 month and 4 hour I use, and then 1 hour, 15 minute, 5 minute. You can switch between those three kind of like in between, like 1 hour, 5 minute, 15 minute, 5 minute, 1 hour, 5 minute. But usually I just like to use all three of them. It's very useful. And 90 minute as well. I did put 90 minute in here, but that's kind of just out on the side. I use the 90 minute as well with the 5 minute, and I actually should have put that in. But if you're listening, add that in. 90 minute, 1 hour, 15 minute, and 5 minute. And then for our lower time frame, we have 3 minute, 2 minute, and 1 minute, which I both use to read which is the best low time frame candles that are giving me the best structure for entries. And sometimes, honestly, it's been mostly the 3 minute because we've been so volatile. The retraces have been really good for order block structure and candle bodies touching each other for entries. But the 2 minute and 1 minute is usually the go-to. You have to find out after like probably 15 minutes of price action if the 3 minute is worth it, if the 3 minute is really what's leading or not. But that just comes after market experience, and it helps knowing whether we're trading on the 3, 2, or 1 minute for the given day and if it changes throughout the day. And then for the seconds, 30 second and 15 second, I did mention how to trade the 15 second and 30 second. It's quite simple, but it does take some patience. For the 15 second, you notice that there's so many gaps all everywhere, like literally so many gaps everywhere. It's the 15 second chart. It's crazy. It's noise. And so for the 30 and the 15, how the higher time frames, we'll just say the 3, 2, and 1 minute chart, are going to trade on the 30 seconds are the 30 seconds and the 15 seconds, they're still market maker models. And those 1 minute candles, those wicks, are going to be 15 second, 30 second candles that are trading into the slight gaps and for value gaps and gaps between candle bodies that are on the 15 second, mostly the 15 second, not as much the 30. So 15 second is really great for getting the lowest point of reversal because it's a 15 second wick, which is like literally where the 1 minute lower part of the wick is going to be for that 1 minute candle that reverses us in the direction at the right time. So the second entry is really, really underrated, but it's very difficult to read because you have to be very patient and you have to wait for the right entry model on the 15 second, which is a fractal to the 1 minute, which is a fractal to the 5, the 15, the 4 hour, and the move that we're trying to take for the day, which is either going to be a 30 minute PO3 or a 4 hour continuation. So time frame alignment, gap alignment, did I mention this? It's kind of the same thing. Gap alignment, like I said, we're either trading on the 1, 2, or 3 minute each day. It's very important to notice this because it will give you a better entry and it will help you hold longer because the 1 minute chart sometimes just is terrible for your psychology some days. And I would just want to be watching the 2 or 3 minute because it protects my stop, it's safe, and it's easygoing. So first of all, the day will be trading better on one of these three, guaranteed. One of them will be better than the other, so always look for it. And then think about limiting in on the body wick slash gap quadrants. And this is something that I said because I mentioned that we're so volatile that if you hesitate on an entry, or if you wait for an extra like 15 minute CISD or another order block on the 1 minute to enter in off of after or like tap into a gap or quadrant or OTE, then you're like risking another 30, 40 points being added to your stop. Like genuinely, it's so volatile that limiting in might be your better option. So added that in. And then session liquidity and time frame alignment gaps. Usually when we're marking out session liquidity, our time frame aligned gaps, our 15 minute gaps are maybe like 1 hour gap at CE of the day that has session liquidity below it, or our 4 hour gap, which is really important and really great to trade off of if we have intraday. These are what I'm looking to align, session liquidity and gaps, because the most important thing is OTE. OTE establishes our ranges, and then these gaps and the session liquidity shows me where, right here we have a Kraken correlation that leads us higher, shows us where the sweeps are going to be, where the OTE is likely to retrace to, and then where we're going after that. So this is very, very slight OTE retrace for the 4-hour PO3 that was used in continuation higher. So it was a sell-off. So we were 4-hour PO3 sell-off and then a reversal. So this is very unusual this was kind of a weird day. I think it was a news day. I know it was slow. It was very slow for the rest of the day. But noted right here for the PO3, whether it's 30-minute or 4-hour, usually 4-hour because you have room for 5-minute candles to be printed. Use the 5-minute for standard deviation / OTE. We're going to go really quick. I mentioned this standard div of a 5-minute retrace, -2.5, and there's -4, literally bottom tick. I do this all the time for standard deviation, standard div of the 10 a.m. retrace into 30-minute PO3 range. Doubling that range would be right here, and then further from that, you have your draws and liquidity for the higher time frame. All right, let's go back on the slides. Otherwise, you understand what standard div is used for. Projections, when I say use it for the 5 minutes, that just means 5-minute retraces are the most likely to be respected. And if you're going for -4, make sure it's like you have 3 distribution cycles aligned, because -4 doesn't get tapped as often. Like you have to have 3, 4 cycles aligned for -4 to get tapped usually, or it just ends up playing out over a longer period, so you have to wait a bit longer. Something like if you were to use a retrace on this, I don't even know what retrace you'd use on that, but like this -4 probably got tapped. I mean, this was like a daily distribution day, so you just have to wait. You just have to be patient. But partials at -2.5 is always incredible RR, no matter like where your entry is for the model. It's always incredible RR if you hold for that standard div. So last thing that I didn't go over was continuation criterias. So for the model that we trade, we know we have the 30-minute PO3, and then we have the 30-minute PO3 that can lead into our 4-hour or our daily candle, which is including the 90-minute candle. So that's basically holding from 9:30 open till 12 p.m. or 2 p.m. Then we have our 4-hour PO3 reversal or continuation, which is how we use 10 a.m. OTE and 10:30 continuation. 10:30 continuation is just leading into that daily candle, like I said, or a 4-hour draw on liquidity. But it can also mean we have a late reversal. This does happen sometimes, and if it is moving in the direction of draw on liquidity, usually that's why I say 2 p.m. will be the best exit, because you want to hold for 2 90-minute candles. Usually one isn't enough, and the second one will lead to the draw on liquidity. So these opens are really what we're looking for. These are the most important times. We have 10 a.m., which we're looking for reversals or continuations from, 10:30, which we're looking for continuations from, or reversals if it's still there. And then we're waiting for the true microcycle open, the next true microcycle open, and actually macro, and last macro of morning that I'm looking to trade, because we have a true microcycle open here, and we're after 10:30. Usually this is when the stalling stops and our direction is chosen, because we're going into the distribution cycle of our right here. No, this is not a great example. Getting into the distribution cycle of our microcycle, of our next microcycle. If I can find a good example, like right here, this would be our opening for our next microcycle, and after that we would have taken liquidity right after expansion of this next range, which is really, really sloppy. But you can see how waiting for this to open and then having some sort of safe protected stop above this high true microcycle open shows you that, okay, we expanded, accumulated, we're going to manipulate and distribute down to our drawn liquidity. And expansion, if we get 2x quarters, usually that is a bigger move down. So that's why I like to wait for 2 p.m. to see if 2 p.m. is really giving us some movement. If it's not, then usually I exit by there, because I don't want to hold after 12 for most days. But in some cases, there are great outcomes. So these are the entries that we're going to look for. Let's go into the examples. So first, let's get into 30-minute PO3 examples. For the 30-minute PO3, you have this simple model. Like I say, for 30-minute PO3, we only need 2 Kraken correlations. We only need the really true microcycle open and 90-minute. You can really work with one if you have like a regular trading hours SMT at the low, because that's usually a temporary hold unless it's like something off of this. We have a new weekly opening gap up here, and we have regular trading hour SMT, but we had more aligning confluences, and this just ended up being an entire daily move. So 30-minute PO3, 10 a.m. reversal. Obviously, we're looking for standard div, we're looking for a SMT in this range from 10 to wherever 10 inverses. See this, where's our 10 a.m.? I don't think I marked, oh, here we have 10 a.m. price kind of hidden right here. But what I'm looking at is 10 a.m. price, while this is creating a CISD, a crack correlation above here, and then even a smaller one internally is an even higher probability example. So this was a great short position for 10 a.m. reversal. For 30-minute PO3, first presented, got inversed. We were trading on these quadrants. We had a bullish daily SSMT, true New York, and really high of the day was the target. I was surprised that it actually reversed on this day, but that was the great continuation reversal that we got for 30-minute PO3, and then continued the trend lower for 10 a.m. reversal, which kind of a strange 10 a.m. reversal on that day. Then 30-minute PO3, 10 a.m. continuation. In this, we're always going to have a 10 a.m. manipulation to the opposing side of our drawn liquidity, which is usually just damage into the 30-minute PO3. I mention all the time the standard or the OTE retrace for safe stop is 90%. So if I put a standard, or I keep on saying that, OTE retrace on here, 90% would be about like right here. We would be about right there. So that's a safe stop. This low could have still been swept. It was discount low. So our 30-minute PO3 and 10 a.m. continuation is probably one of my favorite models to be trading. This is when I know that I'm holding for longer, and either am I going to exit based on 10 a.m. possibly reversing or retracing to create, I don't know, whatever, to time distort us before our drawn liquidity is hit. Because in this case, we have SMT. Yeah, we have SMT, but is this really going to be a 10 a.m. reversal, or is it 10 a.m. retrace to manipulate into the 30-minute PO3 range to then continue to our drawn liquidity? So determining whether it's that version or the other one where we're just reversing is very important, because that basically is make or break on your trade, because it's going to retrace to like basically your stop loss if you didn't get a great entry. So it's either take profit or just exit at nothing, or wait for the entire TP to be hit. So these are a bit more difficult to trade. It takes more experience, but it's the most rewarding as well, because you get very long holds if you get continuations to 12 p.m. and plus. So those are my favorite. 30-minute PO3 with the daily continuation. And something I need to mention is the 15-minute confluences, because I mentioned right here, 15-minute order block, we dropped immediately from that. There is another right here, 15-minute CISD with a 15-minute CISD. We traded right under that, even in the 1 minute. And then a 15-minute breaker block as well. After this first presented low got hit, we didn't even trade into any of this. All we did literally was, let me open this up again. All we did was trade below in that first presented under true microcycle, and then just dropped thousands of points this day. I think at least 1,000 points. It was like a 900 something thousand point day on this day. So 15-minute is the most powerful. I will say this one time only. 15-minute CISD. If you get this in the day, in the open, and a breaker block, it is going to dump. Price is going to dump. It is most likely aligned to have an early distribution like today, like this day. We have an early distribution, then continues for the rest of the day. Sometimes it might be a little slower in the range, like that is compared to this, but after 15-minute BPR quadrants, literally once we left that, look how low resistance we got. We dropped, and then we dropped after 10 a.m. and 10:30 got its opening and wick created. We just dropped and dropped. That's what I'm telling you is happening all the time. 15-minute order blocks, 15-minute breaker blocks, 15-minute CISD. There's a 1 minute breaker block hidden right here, and even that was so significant to send us lower, even a hidden, because we had 15-minute CISD at this top, and then our 15-minute order flow is being respected. 15-minute is so important when it comes to the day, especially when it comes to catching the move of the day off of a 30-minute open that creates a breaker. And if it creates a breaker on the 15, Dude, there's gonna be so much movement in the day. I guarantee you, in this range, it'll probably be at least like a 600 point day. And that's back tested too. I know for certain after a 15-minute CISD, we're dropping aggressively. After a 15-minute breaker block, we have safe stops at CE of that breaker block. Like literally, so much has been collected on this. I've watched it play out so many times. I love a 15-minute breaker block, 15-minute CISD. It is probably my favorite thing to trade. You don't often see a 5-minute as much. 5-minute breaker block, yeah, but like a 5-minute CISD, I mostly use that to exit out of trades because then I know we're probably reversing higher time frame 5-minute to the higher time frame 15-minute. But if it's 15-minute, then it takes a lot to move the 1 hour. So I know 15-minute is going to be a pretty big reversal if it has a CISD, especially with a breaker block. So important things for 30-minute PO3. You have a lot of potential to hold on these. It all depends on how you read 15-minute, the 90-minute closes. Like I say, you got to be aware of when these wicks are going to be open and when the CISD is opening. So the 4-hour CISD and the 1 hour and the 90-minute CISD is very important. Like I said, we're waiting for those wicks to be created because once that damage is done, and like after that inverses, it doesn't come up to that again. It does not. I said have stops at 10. Like look at that. You had stops above 10 a.m. price when we inversed it. It would not get touched. It would be ticks away, but it would not get touched. And so that's the confidence I have when I trade my model that my entry is not going to be touched again after I get in on the right entry. This 15-minute SMTF right here was the confirmation. It was really late. It was really late. But if you waited for the next true microcycle open, like I say on my entry criteria, we have 30-minute PO3 at open, we have 10 a.m., we have 10:30, and then we have 10:50 to 11:10 is right here. It's this small area where we're waiting for our true microcycle open, our D and X, and then AM or XA to be put in place, and all this nonsense is going to happen. And then at the right time, at our true microcycle open, we get a Kraken correlation, 15-minute high time frame, a second 15-minute SMTF above, 10 a.m. is below, and there's no reason for us to reverse here. We have two 15 minutes. We're trading lower and lower from this breaker block. Like so many, look at all these confluences. So after that, when we displace off that, after true microcycle open, we're into what I'm going to assume is XA, okay, cumulative distribution quadrant, which is kind of lackluster right here, but it's moving. After that displacement, first for value gap tap, stop at literally the top of 30-minute PO3. Sorry, I keep on saying, I say these incorrectly all the time. On the top of 90-minute PO3, 10:30 opening. It would not touch it again. That is such a low stop right there, and you would get like 1 to 4 with it leaving just off the screen where it is right now as a screenshot. That's how precise it can be. If you wait, sometimes your stop will get lowered. Sometimes it just will. By waiting for price action candles to print, sometimes it just looks better later in the day and you just get a better trade. So this is what I'm saying. 30-minute daily continuations are such powerful entries that you can get. These are trades that will net you like 10% plus and whenever you take them. Like even if your stop is 50 points, you can still get a 10% trade. You can still get 10R. You can still find 15R in this trade. You can still hold this for 3 hours plus if you get in at the right time. So very important. I want you to learn how to trade these very well. This is a 10:30 that I got stopped out on. Look at that. Stopped out on this candle, the one that swept this high. ES did not sweep this. I should have had my stop at this 15-minute SMTF high. It was ignorant because I was sized in heavier because I wanted a lower stop for a high reward. But that was foolish. I should have stuck to my model and I would have been in this trade. No matter what the risk was, I would have been actually in it and not missed it because I had a stop too tight. So this 10:30, 10 a.m. drop after that. 10:30, safe stop at the high, 5-minute, and then after we inverse, we drop. We don't come back to it again. That is how I use this model. CISD for the higher time frame candles. This is what we are talking about continuously. 10 a.m. reversals. Now we get into the 10 a.m. models. So 10 a.m. reversal, right here. Either we sweep liquidity, 10 a.m. is going to reverse like it did in here. We got a 10 a.m. reversal after 10 a.m. Hits our target. Sometimes 30-minute PO3 hits our target, and then 10 a.m. kind of starts early to reverse. But mostly it's 10 a.m. continues to hit the target and then reverses soon after. So something like this, 10 a.m. hit the target, bullish DC, and then after that, at this candle right here, we had a reversal, and this was the confirmation reversal on the 30-second SMT with our bullish micro, and trading above regular trading hours SMT with the ES. I missed this trade. This was not a great trading day, but I did trade continuations to true day open on paper. 10:30 right here, you had a 15-minute gap in between that did not get traded below. So 10:30 after that CISD, look at that. The right time. We had a new cycle open right here. New cycle open, 10:30. After we trade above it, then we get a tap to trade and then have a stop at below the 10:30 opening price, and then trade it to true day open, and it even hit true day open and plus. I remember this day exactly. So this is how 10 a.m. reversal usually reverses. 10 a.m. we'll hit the target, and then we get this is our 4-hour candle, and our 30-minute PO3 range is just useful to find where our reversal point is and then where we're going to actually hit our target at. And 10:30 you can see 10:30 continues. It doesn't really do a retrace like 10 does to 9:30, like in this example right here. If we're doing continuation or like even reversal, we don't trade too much into the 10 a.m. range when with our 10:30 opening as we do our 30-minute range with our 10 a.m. opening, but still something to note. We're usually trading into a gap or like a 15-minute or 5-minute, so that's always important. 10:30 reversal. If we get a later reversal, we have 10 a.m. open here. 30-minute PO3, hit our target. We got our retrace here. 15-minute SMTF is how our 10 a.m. got that internal manipulation. Call it manipulation, but it's just a retrace. We had a SMT at discount, which is how 10 a.m. created our 10 a.m. manipulation to move higher to our draw on liquidity. And then from there, 10:30 was the time for us to make our reversal. And 10:30 reversal, you can either have 10:30 continuation or reversal. 10:30 continuation is the same premise. You're just waiting for 10:30 to move. Usually 10 to 10:30 probably be like lackluster and not really moving. And then 10:30 reversal is actually very good. I like the 90-minute PO3 because it's quicker than the 4 hours. So if you're just trading it to a target, it's usually quicker and just more preferable. But it does take longer for it to play out, and I do like it more because true microcycle open, when it opens sooner, then I kind of know where the direction is going. But if, we're stalled out for the day, then that's really your only option to trade 10:30. And I noticed this is a really good breaker, and we have lower low, higher high, and then we're moving lower from there. But what I really noticed from here was how this 2-minute played a role in this breaker, because the 2-minute was so useful. I didn't even enter in off of it. I entered earlier than that, but the 2-minute was so useful. Stop loss at the wick the wick high that got swept is your safe stop all the time. It does not trade above that, I guarantee you. And that limits your stop loss and helps out so much. So that's going to be the end of the video. I showed you literally everything that I used to trade with, all the models I use, all the versions of the trading that can happen, the continuations, the reversals, and catching continuations, the different ways to get in on a continuation, which is really time-based for your highest time frame entry. Otherwise, just like I said, 5-minute standard div, OTEs for retraces, 15-minute SMTFs, getting in on those. But the most important thing is waiting for these times, because continuation is going to happen based on these times. And that's really what you want to trade. You don't want to trade a continuation that doesn't have a high time frame stop loss, because then you're just in a lower probability trade to get stopped out on. So I will leave you with that. That is the end of the video. I hope you enjoyed it. Bit longer video and just a lot of valuable information. I have been loving this model. I see how it, even how the charting helps my analysis every day and helps me read the story of how price action is going to move from beginning of market open, and even an hour before, when I can have the foresight to see the levels before they even key up or where they're probably going to be at, which is a blessing and a curse, because the better you are at trading, the better you are at analyzing, the harder it is to enter, because then you just have so much information. What's the best entry? Where am I going to enter? Is there a better entry? All these things happen, all these thoughts come about, but you have to remember to be bold. Do not hesitate. Enter when you see your model, and take the loss if you incurred one. And if you incurred one by your own fault, take it and move on. That is the only thing that will keep you alive long enough to find out how well this model works and for you to like literally just perfect it for yourself. There's one way to perfect it, and it's just using it the way I use it because we're looking for the same entries essentially. So the only way to get better is to keep trying and use different lower time frame charts to collect data and to continue to try and try again. So I will see you guys in the next video. Have a wonderful weekend, and we will get back to trading on Monday morning. See you later.